Good morning, everybody. It's Tuesday, January 7th, and this is the AgYield War Room. I'm Dan Dempsey, and I'll be moderating today's session. As always, if you've got any questions or comments, please feel free to drop us a line in the chat area, and we'll be sure to get to it during the show. Overnight markets here had March corn down 3 3/4 at 454. March soybeans were down 11 1/4 at 986.5, and March Chicago wheat was down 1.5 pennies at 539. This morning, we had an export sales announcement of 110,000 metric tons of corn to Colombia. That was for 24. Also released yesterday, one thing to note, Kansas winter wheat ratings, 47% good to excellent. That's versus 55% in November. Good morning, guys. Yesterday, after the close, we got commitment of traders. Funds continue to build upon their long position in corn. They were buyers of about 58,000 corn, putting them in the range of about 224,000 long contracts, which would be the largest since February of 23. Bought some beans, about 29,000 beans, and about 12,000 contracts of SRW wheat. So with that, Dustin, maybe a few thoughts to kick us off here this morning, and then we'll throw it around the room.
Yeah, good morning, Dan. Thanks. Yep, funds obviously relentless buyers of corn. They're reducing their short position of new crop as well, like the other reported category on that commitment of traders report. And we've been above some of these major moving averages in corn. It's all going into this report on Friday. Where do we see that final yield come out at? Average guess has us coming down just a little bit from that prior report. I think we've got it down to like a 182.7 versus 183.1 on the WASD. And, so 50 million bushels of production cuts and carryout projections starting to get lower again. I think 1,675 is the the average analyst estimate. I've heard a lot of people talking about like as low as 1.5, just with how the spreads have performed and how inverted things are. But it's really a world of a difference. We're talking almost 3 billion bushels that the funds have covered from short to long, from July 9th. And the market has had a fairly significant rally. The March contract is well over 50 cents off its contract low. But it's not what you would normally expect with that size of a position change. They've actually contained the market fairly well for that type of a switch. How are they going to perform going forward? Is there something that's going to shake them out of their long position? That's the question I think everyone should have. I still go back to, the economics of, corn versus beans in 2025. We still have this massive discrepancy of how growers are going to get to profitability in mass. And maybe it's another year of pain where your average grower is going to lose money in the 2025 season. But it definitely doesn't feel sustainable. And it doesn't feel like there's a lot of answers out there of how cost structures are going to change in 2026 to start making this a profitable selling price. Does land values come down, or is it the output that needs to come up? And so that's, I guess, the question for the market here. We can continue to go down this path, but at some point, something starts to break within a 1 or 2 year time frame.
Yeah, that's good stuff there. Ben, what's on your mind this morning?
Yeah, I'm with Dustin. I think the market has been suggesting now for over a month that we should expect a supportive report. And if we don't get that, that would be pretty concerning for whatever reason. And then we quickly, we head into new administration. But I think it's worth noting that at least in the East, I think that a lot of the processors have really good coverage. We've had 2 weeks of much lower exports, and yes, holiday season, but I think all eyes will be on weeks 2 and weeks 3 to see if we can rebound and some of that demand starts coming back and see some of the numbers on shipments like we saw back in November and early December. So we'll see. I'm with Dustin. I don't know what's going to shake the long from their position, but it's the commodity market. You never know what's around the next corner. So I would expect that they will be long corn heading into the growing season. Whether or not it requires a little flush before that and they just continue to buy it, I don't know. But certainly it looks like a year that it would make sense to have that risk on it. Still kind of recently low prices and tighter corn supplies than we saw last year. So
yeah, Justin, maybe going back to Dustin's thoughts there just a little bit. You know, we were talking yesterday after the show and during the day, just, you know, the mentality of we're going to plant this next year, right? No matter the economics of this thing, we're going to plant this thing, you know. But I keep getting asked, you know, like, what does 95 million corn acres look like for this market if in fact guys are going to go shoot for the moon and try to get, you know, the yields that we saw this year and kind of plant their way out of this thing, you know? It's a tough question, but
Yeah.
it's on everybody's mind.
Yeah, it is a tough one. You know, in the short run, you can create a lot of pain. We've talked about this for months on the show, and in the short run, the market's job isn't to make everybody money. You know, so if you go buy some asset worth a bunch of money, it's not the market's job to pay you. You know, so if you're overpaying for rent or ground or a factory, you can take a lot of pain in the short run. You know, so you have to have sustainable pain or sustained pain to a lot of people before you start really cutting back production. So in this year, I mean, outside of really marginal growing areas, we're going to plant. The I states are going to plant every acre. And that's just historically what we're going to do. And you can argue that over history, we try to increase production. You try to increase bushels to lower your break even. So it is a really tough question. And it goes back to what South America going to produce. You know, if the safrinha corn crop's really big, if Argentina starts to rain in 10 days, 2 weeks, we're going to have a big South America crop to contend with. And now you're competing on a global scale. So because the high cost producer in the US is feeling pain and there's enough, you know, exportable supplies, it doesn't really matter in the short run. So that's kind of the conundrum we have here. You know, I think corn's doing a good job of being the strongest of the week here. You know, it's the corn or the bean corn ratio is making new lows for the move here today. Wheat's made significant lows against corn. So corn's showing that it's the strongest of them, but you just have this huge, you know, overhanging world market, you know, and we've had a relatively strong US dollar. So we've seen demand. We've, you know, to Ben's point and Dustin's point, we saw that as we were down in the low fours, we did a ton of business. We've continued to be strong on demand, but the supply's just been too big. So now we'll see what the report says, you know, potentially 1.5, 1.6 carryout, which is pretty tight and the world's pretty tight. But I think the market's willing to, you know, bet on South America still. If South America were to step into a big hole, I think that changes things overnight. You know, especially in the corn and wheat markets and beans, you know, because we'll gain more corn acres, lose beans, and try to put things back in balance. But right now it's just tough to really drum up a bull story that says we're going to go to some price that makes everybody money from what I see right now. So the last time we went through this obviously was that, you know, call it 2015 through 19, and it was kind of a, you know, market gave you small windows to make money. And it was when you didn't know what your production was, right? So you had to be kind of aggressive on marketing, you know, and it was tough. So we really went through, I'd call it 5 years of losing money for a large amount of producers. Now this year this is a dramatic year because interest rates, we haven't seen spike like this over the last 2 years, input costs. So the drawdowns are going to be more dramatic than we saw during that time frame. So we might see drawdowns that were 2 or 3x what we saw during some of those years. So the pain could be stronger from the 23 and 24 crops. there is no easy answer here. I wish it was as easy as saying we're just going to go to 550 and make everybody make money, but the fundamentals aren't really justifying that yet.
Yeah. So if I'm hearing you right,
it's just, I don't know. And it's tough because, historically, when we see these really bad margins or negative margins going into a growing season, there's gonna be a lot of conversations with banks on how much money they can borrow. And a lot of times you'll see cheaper crops like soybeans get planted, not because they like that or the price is saying it, but because it stretches the dollar to be able to plant more acres. Right? There's a lot of things when you plant beans, it takes less trucks to haul, it takes less bin space, it takes less drying, all those kinds of things. It takes less money to plant. So if you can, if it's $200 an acre cheaper, you can plant more acres if you're only getting X amount of dollars from your bank. So we have seen that where maybe the soybeans telling, the ratio is low at 2.2. Maybe it has to go lower, to get more corn acres, and more likely lose beans, not really gain more corn acres, but lose bean acres. Especially if Brazil looks like it's going to finish strong. Argentina is obviously still up in the air, but that's the reality, I think, of what we're looking at here.
Yeah.
I'm just saying that too. I think that we've seen, a grower be, I think, very patient. This market's been pretty strong since, call it October. And I have concerns of, the next 2 months of producers needing to generate some cash. And all of a sudden you have everyone, no one's worried about corn when it's trading, 5 cents off its highs and everything is fine. But, what happens if you do just get a small pullback, 15 or 20 cents, and you get to a point where now it becomes nerve-wracking because it's the next 5 or 10 or 15 that really become problematic. So I guess I'm in the camp that I really like the uncertainty that corn presents for Safrinha in U.S. growing. I think it's a compelling story with the stocks that we have, but I think I would lean towards not looking at bigger breaks if you wanted to find some length in that time, not chasing it here, because I think the next 6 to 8 weeks, the market is somewhat vulnerable if the report is not supportive enough.
Yeah, and that's a good point, Ben, to add to that. Now you've inverted the corn market. So old crop's inverted. The length of the funds is all in old crop. They're actually still short a little bit of new crop. And pretty soon we'll be in crop insurance delivery. So I think it's going to be really important to look at the 24 and 25 crop combined strategy here and look at where can we use the most subsidized dollars to get the most protection. Where do we need to offload some grain? You're going to have to do a lot of homework in this year. I don't think you can it can't be really lazy marketing. It's going to have to be really, how do I stretch that dollar? How do I get the most protection, and where do I need it? Do I need it when the market's inverted and I already know my crop size is, and I have high interest rates? Should I be freeing up money there, using money to protect the next crop? And what's the best way to do that? So I think you got to really kind of look at that as a 2-year game plan.
Yeah, I posed the question, and I think this kind of goes into Dustin's comments about what is it that's going to shake them loose. And you can do a lot of mental gymnastics thinking about those things, and it may be something that you never considered, and it does become a risk off, which would be, fundamentally would probably be an opportunity. But I asked the question, okay, if that walks in the door one morning, and you're a trader, where would you buy corn, right? Where is that number that you would step in and say, I'm comfortable under these circumstances, knowing that the producer is still long, the managed money is long? Where's that number where you would step in and own corn? And I think, when you start asking those questions with spreads with March 10 over D's, I think you have to back it up a little bit in the event that something like that. It's probably a 1 in 5 type of situation, but I think the going through that is you could probably have a little bit bigger decline than most people would be comfortable with if that were to happen.
Yeah, and it's just a matter of like, okay, so if you're long, if you have a bunch of corn in storage or a bunch of old crop unpriced corn, and you've got another crop that you're buying inputs, borrowing money, now you've got a significant amount of risk, right? So pretty soon you will have, if you can bridge a gap with where you're going to get some crop insurance, you got some farm bill levels that are increasing. There's some things to really exercises that you should really go through and look at where that risk is, to my earlier point, and say like, okay, can we remove some of this unnecessary risk or stuff that I can't really protect in the next, call it 60, 90 days. Because there is going to be, we've already talked to a lot of, banks that we work with closely, and it's a lot of lenders are going to be waking up, if they haven't already, so this is tougher than they thought. So just I don't think you want to put your head in the sand here.
No, definitely proactive, get ahead of it, and as always, give us a shout if you want to bounce some ideas or talk about some of the things that we're looking at here. So we're always able and willing to give you a shot there. Ryland, real quick, coming into the open, strong start to the week for cattle. We're stronger again here this morning. Weak start for hogs yesterday before they battled back. So what do you got for us here this morning?
Yeah, it still seems like we're battling a little bit of the weather premium here on the cattle side of things. No cash yet, but I think everybody's still pretty optimistic that we can see another round of higher prices, especially just how the board has been kind of shaping up. We are in the midst of the roll, so there should be a little bit more added volatility just over the next week. But open interest is increasing, so I think we're seeing a lot of producer hedging. We're still seeing the managed money still add to their long position here, and they were long 129,000 as reported yesterday, and that was up about 600 contracts. So they're still gradually adding here. I think there's going to be some caution as to where the next leg is going to go. I know we're still going to be talking about tightness, over the next 6 months, no matter what the inventory report says, but that January 31st report could mark a turning point here. So I think you've got a lot of good reason for the longs, good reason for the shorts to be pretty aggressive here at this price level, trying to figure out what's going to happen here. But honestly, beef was higher again yesterday, so still good news. There just hasn't not really been a turnaround here, so there is still a lot of confidence that, especially just with the weather in the south, these snowstorms in the south just causing a little bit of just overall kind of transportation issues and such. I think the market's still working through that right now, but should hold up pretty well in the interim. Otherwise, on the hog side, managed money still actively liquidating, kind of caught right now. It does seem like we are a little bit on the oversold side. We are seeing cash start to stabilize a little bit, so that's a little bit of good news here. But yeah, we just keep on making new lows, and if they're going to want to carry that length a little bit forward here, we are seeing that open interest grow in April. And they are still long, managed money still long 108,000 contracts. So that seems like a pretty hefty position going into this time frame, which seasonally isn't necessarily the best, but prices definitely, carry that same kind of bullish trend just between now and 6 months. But it just feels like you priced in a lot of really good news. We're seeing that liquidation from those longs, and all eyes are on carcass right now and cash. And if that starts to dwindle here or see bigger swoops lower, it just feels like downside risk is going to increase.
Very good. Appreciate the update there, Rye. We're open here this morning. We got March corn down 453 3/4. March soybeans are down 10 3/4 at 986 3/4 is the last. And March Chicago wheat's down a penny at 539 3/4. We appreciate everybody that tunes in on a daily basis. If you wouldn't mind, throw us a like and subscribe. Keep you up to speed on everything that's going on with AgYield. And again, thanks to everybody that tunes in every day. Every day that the markets are open, we're streaming live on X, Facebook Live, and YouTube Live, 8:15 Central Time. Appreciate the thoughts and comments here this morning, guys. It was a good conversation. Hope everybody has a great day, and we look forward to talking to you again tomorrow.
The War Room is proudly presented by AgYield. For over 50 years, the AgYield team has provided grain marketing and risk management solutions for growers across the country. Our veteran consultants harness cutting-edge technologies to pinpoint risk, optimize market performance, and protect your farm's profitability. Discover a new approach to farm revenue management at agyield.com.
Hey guys, Jack here. Be sure to support the show by hitting the like button, leaving us a comment, and subscribing to the channel for all the latest updates. Thanks for watching. We'll see you next time.